I'll let David get sat down. Evening, everyone. Welcome to the RSA. Welcome to the Great Room. Wonderful to see you all. I'm Andy Haldane, I'm the CEO here. And this is the first in our autumn series of events. And what a treat we have in store. Absolutely fantastic lineup, a truly expert panel to discuss this fascinating question of what we do with the money that's stuffed in our pension pots. And indeed, is that suitably servicing our needs as pensioners in years to come? So as well as those in the room, we've got a lot of people online, I know, watching in. You're very welcome. You want to get involved in the conversation, you can drop some questions into the new YouTube chat or our Twitter using the hashtag RSA pensions. We'll try to get some of those questions towards the end. Let me just introduce briefly our distinguished speakers this evening. So I'm delighted to be joined by Michael Tourey, by Dame Elizabeth Corley, and by David Pitt-Watson. It really is a powerhouse panel we've assembled this evening. Some of the most thoughtful and experienced practitioners and thinkers in the pensions and investment field. I'm starting to my immediate left with Michael. He's going to kick us off this evening. Michael was co-founder of investment firm Andra Partners and former head of UK investment banking at Morgan Stanley. One of the wisest heads around on these topics. Tonight's event was in part sparked by a conversation you and I had, Michael, prompted by an excellent report you may have seen from the Tony Blair Institute that Michael co-authored. If you're watching online, you'll find a link to that in the chat. It's called Investing in the Future. And if I can turn to Michael perhaps first. In your report, you and your co-authors stated that that's a pretty strident statement, this one. UK pension system, the UK pension system is broken and long overdue for sweeping change. So my simple question really, Michael, to you is, please tell us why.
Okay.
And what we're going to do about it.
Okay, good. Thank you. Well, thank you, Andy. Thank you to my fellow panelists for convening this important discussion tonight. You can imagine being described as a kind of pensions expert, the number of invitations I get to really fun parties. So I'll begin, I will answer your question, but I'll begin just maybe explaining why this is of such importance and why I became so focused on it. And as you can tell by my accent, maybe you can, Americans and Canadians, but I'm a Canadian citizen. But I've lived in the UK for 30 years, more than 30 years. In fact, it's my adopted home. And during that entire period, my kind of occupation, if you will, my day job, has been to help companies, mostly in this country, but around the continent, but mostly in this country, to serve them, to basically assist in creating long-term value and to grow and to innovate. And in that 30 years, it's hard to pinpoint exactly when, but say 15 years ago, we call it just roughly halfway, the trajectory and the confidence and the conversations I was having with companies began to change quite noticeably. And the level of global ambition, the appetite for risk, the appetite for growth and long-term investment just began to diminish. And as I probed the people I was serving to understand what was behind this and what was actually the root cause, it was clear there was, the consistent theme was there was no audience left for that kind of message, for that kind of story, for growth, for innovation, for risk. And I've had it said in numerous, we'll come back to the reactions I've had from people, this is all culturally determined. I've never bought that because this is the country that invented capitalism. We are still one of the most innovative, if you look at the number of unicorns, the technology, the research engines in universities, this is an incredibly innovative and forward-looking and dynamic economy. But of course, without capital, of course, that dynamism comes, it diminishes. And so one chief executive, very memorably, said to me that it felt as if the entire corporate ecosystem was encased in an airtight chamber without the replenishment of oxygen, obviously the air, the capital is the air, and that every year with the dividends and the share buyback, some of that air leaked out, and you had effectively the almost relentless asphyxiation of the corporate sector, because without capital to replenish and extend the time horizon. So it was that kind of really alarming set of messages I was getting from the corporate clients I was serving, who really, for all their ambition, all their aspirations, without the capital to fulfill those ambitions. So I began to assemble the data that if there's train spotters in the audience and you've seen the full report that Andy referred to, all began to gather this data almost a decade ago and to compile it into what became the report. And it was kind of the data is not only startling, but throughout that whole 10-year period, it got worse and worse. So now to answer your question. So in speaking to people about this and showing this data, it was really two things that struck me. One had a kind of cultural dimension, and I think what's interesting in this country, I've now lived here for so long, is there is a sense if something isn't visibly broken, there's very little political will to fix it. Unless the roof is crumbling, for example, it's very hard to actually get some of the political will to make a change, and the inertia is a very powerful force. So when I went around to talk to people, that was kind of well, okay, it's not visibly broken, this is 7, 8, whatever years ago. And the second thing, which is really profound, and I think it's of broader relevance to the audience of RSA, is this sense of futility, that even if these things are broken, what can we do about it? In the sense that any one individual, people feel powerless in the face of all the unresolved issues we have in this country. So in a sense, you almost have to wait for your break, and actually as it happens last September, we had two breaks came at once. Firstly was this crisis in the gilt market, which was a manifestation built up over the previous 15 years, the slow boiling frog, and all of a sudden people understood this system was in fact broken. But it took that to then change the conversation, and I had the number of people, I lost count of the number of people, who then came back to me and said, now I understand what you're talking about, that putting all the assets of the savers of this country into fixed income at low interest rates wasn't a very good idea, actually. And then people began to make connections, and so that was the first break. And the second was a fellow Canadian, in fact, by coincidence, John Bell, who then connected me with the Blair Institute. And it was really John's connection with the Blair Institute that then led to the taking these sheets of paper that I'd been going around, this little mini roadshow around the country with, turned it into something that actually had a platform and a real voice, if you will, in the Blair proposals. So then now to the second part of your question. So that's the why and the kind of the explanation. So the proposal is very simple. If you look in every major industrialized country in the world, it's accepted that to have secure long-term returns for savers, to have productive assets for development of the economy, that you need three crucial ingredients. You need scale, you need time horizon, and you need professional management of diversified assets. And if any one of those three ingredients is missing, then the system doesn't work. It doesn't deliver for savers, and it doesn't deliver for the economy. So looking around, well, do we have that? In fact, there was a perfect made-in-Britain solution was actually there. It didn't have to be, this is the only solution, but it's very hard to invent something new. But there was something which has been there since 2006 or 7 when the PPF was first created. And of course, it's living proof, and I won't bore all of you with all the data, but if you look consistently since it was created, the funds in the Pension Protection Fund come from the DB system that we're talking about. And they transfer in when a company fails. And it's ironic that to get the professional management at scale of your pension fund, you have to fail. The company has to go bust first. But once it happens, there's consistently 3% better returns in the PPF than the funds from which they've been drawn. So we had in front of us this solution. As I said, it may not be the only solution, but it's certainly got a debate going. So I think that's kind of is it the only way to do this? Of course not. But the direction of travel, I think, is important. There's now a recognition that these ingredients are important. And I've never been convinced the sense of futility that you can't change these things. Of course we can change these things. And the global financial crisis was that. It was the global financial crisis. This problem was made in Britain. And if it was made in Britain, we can fix it in Britain. And one of my heroes when I was much younger than I am today was Robert Kennedy, who at the end of every speech he would quote George Bernard Shaw, and he would say that some men dream things as they are and say why. I look at things and say why not. So effectively, so I think that's the message that I would like people to leave here today with, is this is something we can do something about, and it's important that we do that. And I now hand back to you and to the rest of the panel.
Well, I'm going to turn to Elizabeth in a second. What has been the response I think from government in particular, to your proposals. Have you?
Yeah, it's in motion in a sense because the Mansion House speech, I think, was stimulated in part, not just by, there was other work that was going on, but the Mansion House speech was in part stimulated by, I think, some of the work that we've done. And I'm not going to be unfair to, and obviously, specific responses, but I think if you put the responses in blocks and categories, probably a quarter, roughly, in a sense, sort of kind of very doctrinaire free market approach. This is a kind of market outcome. This, we're not in a very good place to invest. It's unattractive here, and the market's voting with its feet, and kind of it's all going to America anyway, and so why bother? That was kind of one. That's obviously a very, very dispiriting approach that I completely disagree with. We can't do anything about this. Second bucket is, again, it's very odd that the insurance industry will somehow rescue this, and that they will turn these assets into risk capital for long-term growth. And of course, there's no evidence of that. It's not what they do. Insurance companies, that's not what they do. And but that is, there has been a body of thought. And if you look at the questions in the Mansion House speech consultation that followed it, the questions were framed in such a way as to actually believe that there was some very important role for the insurance industry, and there is a role for them, of course. But the idea they're going to take the nation's savings and invest it for long-term growth and find the unicorns and invest in innovation R&D, in no other country does that happen. It's not going to happen here. And then the third category, I won't say this is limited to government, but certainly was an experience, was the relatively limited understanding of the dynamics of this problem and the importance of it, and the international comparisons, which meant that it was quite difficult to actually have a conversation with a number of people because the levels of knowledge are so different. It's very difficult to have a debate, actually. So, but the good news of all this is a recognition that this is probably a good time to make a change.
Fantastic. Michael, thank you. Let me turn to Elizabeth. For me, I'm sure to many in the room, huge experience in financial services over a number of years as CEO of Allianz, which is when we first met, actually.
Global Investors.
Global Investors.
Yeah.
Many years ago when we first met and worked together.
It was old Mercury days.
Yeah. And prior to that at Merrill Lynch Investment Managers, at Coopers & Lybrand, and at Sun Alliance. She was appointed chair of Schroders in 2022, director of the Green Finance Institute, and perhaps most relevant for this evening is in a role as chair at the Impact Investing Institute, where in the context of Levelling Up we were discussing as well just a year or so ago. Yeah. Elizabeth, if we turn to you, and one of the Institute's flagship initiatives is around developing practical toolkits to encourage fund managers to deliver on the just transition. Yeah. Could you say a bit more about that and how that's going, actually?
Absolutely. So, first of all, it's absolutely delighted to be here. Thank you. And great kickoff. So, brilliant. I'm looking forward to the conversation. So, the Impact Investing Institute grew out of exactly the problem that Michael described, which is the UK innovated significantly around impact finance, which is investing for a financial return and an outcome. It's not either or, it's both. We did a huge amount of work, a lot of innovation was done, starting with Gordon Brown into David Cameron, and yet 5-8 years on, we were lagging the rest of the world. The bright ideas were going elsewhere, we were not raising it. So the UK government said to me, why is it the UK is not doing this? And everybody expected we'd go back. I have assembled a group to advise government on it, which is when the first time we started talking about this. And everybody expected we go back saying we need tax incentives, we need better regulation, we need better legislation, we need this, that and the other. The reality was the industry wasn't doing it. We were not innovating and we were not moving at the pace we needed to do. The vast majority of what we could do was fix it ourselves. There were some things that were a bit uncomfortable around ombudsman schemes and technical stuff like that, but we were not doing it ourselves. And what happened was, by getting this group of market practitioners together and saying, come on, what's the art of the possible? We can fix this. Out of that grew an Impact Investing Institute. We were literally a 6-month advisory group for government, and that was 4 years ago. And this body self-formed, we self-financed, got a bit of money for government around key programs. And one of the things we looked at is the fact that there was a big focus on green, absolutely right, on climate change and environment. Nobody was thinking about the social and community consequences of green programs. Nobody was thinking about it. And so we said, not only are we going to look at impact, capital being deployed to deliver financial returns and outcomes where it's needed most, how can we look at a just transition, a sustainable transition to net zero? Because if we only focus on green, and I remember having conversations with the then Governor of the Bank of England about this, we won't get there because there'll be a political backlash, there will be a community reaction, there will be a jobs and growth agenda that dwarfs the need for sustainable environmental change. So we did some work when the UK was president of the G7 on an impact task force looking at what's getting in the way of just transition finance and what is just transition, because nobody really had defined it. And it was absolutely investing for net zero, absolutely. So a real clear determination that this is part of either mitigation, amelioration or solutions for net zero, with a societal contribution, whether that's jobs, growth, community engagement, whatever it is. And the third piece that nobody was talking about was community agency and community engagement. Because you can get the first two, ticking the job on boxes on jobs and growth, that's fine. But if the community that's going to be affected by whatever you do in terms of moving to net zero is destitute, is a stranded community at the end of what you do, again you have that political risk and it isn't going to be fair. So we worked with asset managers, asset owners, development finance institutions, multinational development banks around the world to set a set of recommendations. And out of that came some principles for what can you do practically as an asset owner or an asset investor. And then we launched a challenge, which was, okay, that's great, those are words, it's a toolkit. It was co-created. We put it out to significant consultation with NGOs and others, because it's all very well the capital markets world saying we're coming to the rescue, but the people who are really on the front line are really on the front line and we're not. So we have to be very humble about the fact that we only see through a very narrow prism of what's going on. But the thing we then said was, okay, will you start investing in this way? And we have 4 very large pension funds who've said, yes, we are going to start investing in this way. And we have about 10 other asset owners and managers investing in this way to prove that it can be done. And it's not a constraint framework. So that's what it is. Why is it relevant for what we've talked about productive capital? Because the huge investment opportunities in the next decade, the huge opportunities for growth and for the economy, are going to be around a pivot to a more sustainable future. So there's massive opportunity here, and technology, whether it's digital or whether it's engineering, is going to help that. And so if we can get this overlap between a competence and a confidence in pension funds, trustees, fiduciaries in other places, that this is the right thing to do, that it is aligned with their fiduciary duties. If we can get that aligned, and we do a lot of practical tools for pension funds, foundations and charities, to say, you can do this. And what we also need, though, now, and we're responding to the consultation post the Mansion House speech, is DWP really need to modernise the whole concept of fiduciary duty and what is in the benefit of the members' interests. That is quite archaic, and we can debate whether it's cultural, whether it's a sort of recidivist argument as to why it happened, or whether it's because we're very, very risk averse. But the reality is, and I've been a pension fund trustee of a small scheme, the fear of God is put into you, whichever your God is, when you become a trustee, that you are personally liable, and you are forced to rely on a lot of agency advice. The agency advice for small schemes is not what you just described as a source of success. It's a cost-effective way of delivering a cookie-cutter solution to every small scheme that there is. And having been a pension trustee on the receiving end of that, you realise there is a huge amount of work that needs to be done. But scale, and the ability to do scale, is part of it. And free markets won't do that because there's no incentive to drive scale on its own. You've got to create an incentive structure for doing that. But I also would say there's a lot of trustees out there working incredibly hard, incredibly nervous, and working really hard, and telling them what to do as if they haven't got a responsibility isn't going to be the answer as well. You have to create a framework and incentive structures to drive this forward, and then a toolkit to enable them to do it.
Given what you say, Elizabeth, there, really fascinating. Would you view the Mansion House reforms as a step, therefore, in the right direction, if not controlling, steering a market to a different sort of solution?
I think as a signalling effect, it was quite powerful.
Right.
I think signalling, and I think there was a lot of work went into that. Wearing my Schroders hat, we have a long-term alternative assets fund, an LTAF. There are things that you can do now in the UK that you couldn't do before. We have DC schemes who want to invest in that. So I think, yes, as signalling, but you have to think about pace, you have to think about how quickly we wish to move, and you have to think about the way in which you get an interest alignment. The incentives are not aligned to make that happen instinctively.
Yeah.
And if you have major inertia in the system, which we do, there's a lot of losers if they don't move ahead of the curve or with the curve.
Yeah.
And there'll be a natural inertia effect, even if there's confidence and culture to drive forward. So I think it was signalling, but I don't think the answer is then to mandate and tell fiduciaries what to do, because they have a duty of care and a duty to their beneficiaries. I think it's enabling them to do it, getting the scale you need, getting the competence, getting the governance, and the facilitation that we talked about years ago. And this is really a question for you, because you're expert on this, that move them there, but at a pace. So I think it's a carrot and stick, if I'm really honest. The carrot is a great opportunity. The stick is, if you don't do it, maybe we have to come and help you.
Help you in inverted commas, right?
We're here to help, you know.
Here to help. That's a beautiful segue to David, actually. And just to introduce David, a distinguished career in pension fund investment, leading the activities around responsible investment at Hermes Fund Managers. David helped found the Principles for Responsible Investment and chaired the UN Environmental Finance Initiative for the Paris Climate Conference. He and I have also known each other forever. And close to home, RSA house home actually, David has led the RSA's Tomorrow's Investor program since its inception way back in 2008. Remember that? And this is a group of RSA fellows who've been working together over a number of years now, latterly under the auspices of the CDC Pensions Forum, asking what we need to do to reform pensions by first asking, extraordinarily, what do pension savers actually want?
Yeah, and it's interesting. I'd quite like, Andy, if I can just do sort of 3 or 4 minutes on that process and where we reached,
please.
And then start to talk about the investment and the things that Elizabeth and Michael are talking about. Because, yeah, I was very happily working at Hermes in the noughties, and what Hermes, by the way, was at the time a pension fund. It was owned by the biggest pension fund in the UK, BTPS, and we were trying to take responsible investment really, really seriously. This is other people's money. We're managing it for them. How would they like to see it invested, and how would they like to see it stewarded? And as Elizabeth said, they wanted a financial return, but there wasn't much point in a financial return if it was made by destroying the very society and environment in which you were going to live. And so I was very excited about all of this sort of stuff. I thought we were being very successful. And when the RSA, I was a fellow of the RSA, came up to me and said, well, have you ever actually asked any pension fund saver what they want from the system? And I said, no, it's far too complicated for them. We experts can work it out. And they said, no, one of the principles of the RSA is you've got to help the people themselves to meet their own needs. This is not about clever people passing laws. It's about how do we do this. You're going to do this by setting up a series of citizen juries, and we're going to ask the citizen juries. And we brought along some experts. Some of them are also RSA fellows who are in this room right now. And I met Harry Mann. He co-leads this with me, and I think he's got something that looks like COVID, so he's on the line. Adrian Boulding as well, another RSA fellow who's done a huge amount in the last couple of years. Anyway, we did these citizen juries. And you can imagine I was really excited. Was this going to be about licensing drugs to the third world, or BP's environmental policy, or the billions that were being wasted on daft acquisition schemes? And so I gave my evidence, and other people gave their evidence as well. And they said, most of the juries, well, it's all very interesting, David. I'm sure you're having a good time doing that. But what I'd like to do would be to give my money away to somebody I can trust. When I retire, I want the best possible income that will last me till the day I die. By the ways, we are absolutely shocked at the scale of fees and how much they affect our pension. When they learned that 2% a year over the lifetime of a pension takes half your pension in fees, they were sealing about that. And that cost one was the first thing we worked on. We had an OFT referral and capping of fees and independent governance committees. And by the way, there's still RSA fellows working on that, Rustin Smith and Andy Agatangelou. But the bigger issue was, how do we get people an income for life? Because a DC pension, which is what most people in the private sector get these days, is not an income for life. It's a tax-advantaged savings scheme. And you can draw that down, but if you live till you're 100, you are going to run out of money at some point. Or you can buy an annuity, but that costs you an absolute fortune. So how do we manage to create a system that does that? And again, we set up a steering committee. Harry and I were doing a lot of the world. John Banham chaired it. Robin Ellison was a member. Lindsay Thomas from the FCA. But anyway, we looked around other countries in the world. Canada was one of them, actually, that comes out tremendously well in terms of its pension system. Michael Holland as well. We did our own studies. We commissioned studies. We used some of the studies that had been done by the British government. I think Julian, who's in charge of private pension policy at the DWP, I suspect, commissioned some of them and said, look, if you look at the structure, the collective structure that you have in a Canadian pension fund or a Dutch pension fund, that just gives you a better return and a more reliable return as an income for your life than you do if you save and then buy yourself an annuity, or if you save and you risk that you're going to run out of money. And so we started our work. It's taken a few years on, it's called collective DC pensions. So we all save into a big pot and the pot pays out. And it, as I say, is likely to give you a 30% plus better return than you would get with a DC plus an annuity. It's a really, really substantial upside. And we now have, I thank Julian and others for the enabling legislation that has been passed to allow that to happen. We're now going through the secondary legislation. I don't know if we've got anyone from Royal Mail here. They've already got their fund and they will set that up live in January. And we're now working, as you say, Andy, with the CDC forum. Adrian, I mentioned Hilary Salt. Others outside the forum, Henry Tapper has been a great supporter, another RSA fellow, and the TUC and the DWP and Royal Mail, and everybody's involved in all of that. So that's good. But I think the really interesting thing is it also has some really interesting knock-on effects about how the money gets invested. Because it's quite intriguing. If you look at where the primary investment in the UK is coming from pension funds, yeah, so the toll bridges and the airports and the wind farms and all of those sorts of things, it's not coming from UK pension funds as much as it's coming from Dutch pension funds and from Canadian pension funds. If you remember the work that we did looking around the world and said, well, what is the structure of those pension funds? The structure of those pension funds is the collective DC structure that we are now beginning to implement in the UK. And as Michael says, those sorts of structures do have a long-term and a continuing long-term perspective. They're not obsessed as well as our DC systems are with liquidity. And they have, I would add this as well, Michael, to your list, they have a risk budget. Yeah, so our DB schemes are all trying to make sure that they can match whatever it is that the accountant has said is the liability, rather than thinking generally about how do I give people income for the next 50 or 60 years. So it seems to me that from the RSA, we are coming towards some of these issues that actually I started out at Hermes and that Michael and Elizabeth are raising, that is sort of saying that if we really do sensibly focus on savers' needs, we need to create structures that allow them to invest in good things for them. Now, what might that be? I suspect it is infrastructure that gives you a good return. I suspect, Andy, it's the sort of work that I know you're very keen on city financing, because of the work you're doing with the government. Surely it makes sense that our pension funds can find a vehicle to do that. It's bonkers that we're depending on Dutch and Canadian pension funds. By the way, I'm really happy we do have Dutch and Canadian pension funds. I'd like to welcome them in, but we should be doing that as well. And the key point here is if we want a good pension system, we need to look at both sides of the balance sheet. So there's a bit that's the promise, where I think what we've done at the RSA really is groundbreaking in terms of saying we can give you back an income for life and we can give you a much better income for life. But we need to match that with where the money is invested so that it is invested on your behalf. And we've never properly considered that before, you know, ever. I mean, the Turner Commission just looked at the promise. It never looked at where it was invested. And why what the Chancellor said in the Mansion House speech is interesting is not for a moment that I think that his 50 billion in 2030 is going to transform the British economy. There's much more to be said than that. But because he opened the debate. He said, look, if we're going to have a good pension system, we need to have a debate about where and how this money is invested. And he came after Rachel Reeves, his shadow, had made a speech about a month beforehand saying exactly the same thing. And I think that is right. I think there could be huge advantages if we do this right. I think it's complicated if we do this right for the British economy. And we do this at a point where CDC is now coming through. This is a new system that has a risk budget and really has a long-term and ought to have, as Michael says, scale. We need to build that in. It's a huge opportunity. I mean, pensions, to give you a sense, is 2/3 of the financial assets, household financial assets of the country. 2/3 of it. If you want to know about the money that goes into the city, think pensions. It's 4 times larger than the entire wealth of the Sunday Times wealthiest 1,000 families is in the British pension system. And I think we can do a much better job of investing that as well as making a promise if we think this through properly. And so that's where I'd finish.
Terrific. Well, listen, what 3 fantastic interventions. And I want to leave as much time as possible for questions and for conversation. And I've got dozens sent in advance, actually. But I want to get the room first and to collect a couple from the floor before turning to them. So who'd like to ask a question of our panel about any of the issues that they've raised? I think your hand up was up first. So there's probably a microphone heading your way. If not, just shout. Is there a mic coming?
Microphone. There we go.
There's meant to be.
It's okay.
Shout.
Maybe
It's all right.
shout, or I'll repeat the question if you like.
It's sort of a new captain consensus Chatham House. So I've got a question for all of it's really more for Michael, but also the others. So although DB schemes are in sort of run-off modes, the majority of the UK's pension assets are DB funds, and it's a huge number. I can't remember off the top of my head. It's in the trillions, and I think your suggestion, Michael, is to get the pensions and protection funds to invest them. But there are there are proposals around merging DB schemes from, I think, 16,000 into 10 or something. And don't you think this is a possible option, or is your proposal to put all of those trillions of pounds into the pension protection fund? And that's also sort of a question for David. Excellent, work. But what about the kind of existing DB assets? Sorry, I didn't want to make this out.
You finished your question just in time for the microphone.
Yeah.
I think we heard that loud and clear.
Yeah, it's good. It's good. Well, I'll just start. So the proposal, I mean, if you look, there's 5,500 DB pension schemes in this country. If you look at it's very interesting, David's point, it's absolutely right. On the small funds, on a compounding over decades, the costs actually, because the economics, you have to have a trustee, you have to have a lawyer, you have to have all the infrastructure, even for a very small fund. So the returns over a lifetime for the very small funds are consumed. I think the number was half. Was that your the point, half of the pension fund can be consumed. I hadn't heard that high, but certainly a very, very high proportion. So that was the main driver to say, well, okay, let's take the 4,500 smallest schemes, and the average size of those, of the 5,500, the 4,500 average size is £100 million. So the idea is not to put all the schemes in, but to put the ones that are most disadvantaged by the lack of scale. They call it the smallest 4,500. And do they all go into one PPF, or do you have an amoeba and have two? There's nothing dogmatic about that. But obviously, these tiny funds shouldn't exist in that form. The costs are too high. They do not have access to really good investment opportunities at that scale. They can't invest in bridges and roads. You can't put £1 million into a bridge. This is done at scale by large funds. And it's more in a sense, and forgive me, I didn't get your name at the beginning. I'm sorry. Nick, yeah. It's the demonstration of a good example. If you could put these 4,500 funds into a PPF-like vehicle, it's a £450 billion fund, which sounds like a lot, because it is in this country, but in global terms, it would be like top 20 order of magnitude. And then by setting an example of success, of showing that with time horizon, scale, and professional management, it works, then it will actually, I believe, self-replicate. I have actually huge, more confidence than a lot of people I've spoken to in this country, as a Canadian, more confidence that this system will adapt, actually, in the face of success. It will actually then be able to imitate it and do it at scale elsewhere.
David, anything you wanted to add on this?
Yeah, look, this thing about DB funds is a really good question. It's where the big money is, Andy. I think it is just technically tricky to be able to bang them all together. Also, many of them are of a perfectly large enough size to be able to be investing, but they're not, because they've got this very stylized liability that they are investing against. That's why they're investing the way they're investing.
Yeah.
Now, could we ever undo that? It's not the first place I'd go to, because if I was somebody who had a DB plan, actually I do have one DB plan, and I want to keep that DB plan, because that gives me an income till the day I die, and there's no ups and downs on it, and somebody else has guaranteed it. So I wouldn't go there, but I do think it would be worth the debate of whether this stylized investing against this accounting number is the best way to give people a living income that will last them for the rest of their lives. There was a study that was done, actually, sort of around the stuff we were doing through the RSA. It was done by Willis Towers Watson, and I hope they'll allow me to quote this, where they said in 2020, when interest rates were really low, and you took a stylized DB investment fund and you compared it to a CDC, how much more income would the CDC produce than the DB investment on its strategy? It was like 40%.
Right.
And there has to be something that's to be gone for there. But if we do go for it, you better make sure that you've got the trade unions and the TUC and the people who are not on big wages and who have been protected by what it is that we did in the 60s, 70s, 80s and 90s, that they feel they are properly protected as we do this. But that's why it's not the first place I'd go, and I'd make sure that we've established CDC properly first, and that we can do better for anybody that would move from DB to CDC.
Yeah,
Elizabeth, anyone?
No, I totally agree with that, and I think I have a DB scheme as well. I have two.
Yeah.
And I mean, it is, in terms of the compounding effect, if you've got it with inflation protection of some sort and other things, you know, it is an incredible investment. You probably made the decision when you were 18, 19, didn't know what you were doing, but actually it's amazing. So I think the individual rights of members have to be protected.
Totally protected.
I think it would be great to mobilise that stock of capital as opposed to just the flows, because the stock can be put to work more effectively than just purely the flows. But I do agree with David that it's not an easy thing to do, and you'd have to think very thoughtfully about member interests and employee rights to do it.
Exactly.
I'm going to...
Can I just add one tiny thing to that? Sorry. Remember that we're talking about 4,500, in many cases, tiny little companies. And we use the word guarantee is regular. I hear this regularly. It's guaranteed. I go, yeah, but guaranteed by who? And these often tiny little companies that are a fraction of the size of the pension fund. And everyone says, do you really sleep well at night with that as your guarantee? And of course not. And then when they default, remember, it's difficult. People say, of course it's difficult. It's happened 1,100 times. Companies have gone into the PPF. And it happens just like that. The day they go bust, they go into the PPF. So although it's said to be difficult, it's happened 1,100 times. And by the way, a lot of these guarantees aren't real because the companies themselves are not solid enough. And that's one of the reasons why we've concentrated on the small funds.
Yeah. I'm going to take a question online. which is about, Elizabeth touched on this, I might start with her actually. Is caution, investment caution, somehow culturally built in to the governance and management of funds? And if so, how can we shift it?
So, I mean, we were discussing this before, is there a cultural mismatch in the UK versus other places? I think all I would say is from very personal experience of having that fiduciary responsibility, the first piece of education you get is around caution, risk and personal liability. Now, I happen to have an investment background and a financial service background, so I was quite curious that there was no talk about returns and the promise to members and how we were going to meet them. I think there is an inherent risk aversion, but I don't think it's cultural. I think it's created by the system that we have in place and by the fact that the reaction to a crisis is to double down on protection, double down on risk mitigation, double down on governance, double down on the costs of managing the schemes. So I think it comes out of a systemic approach to the fact that it's much easier to say to somebody, don't worry, your future's guaranteed, versus don't worry, we're funding for your future and you will have an income. That guarantee word is a very popular word, whether it's a public policy word or whether it's an industry word, but it comes at such a huge price. And that's the problem. There is no incentive to offset that. And the reason people move like that into PPF is because the opposite is destitution, because their company's just gone bust.
Yep.
So you've suddenly taken that away. But I thought your point about we don't fix what is invisible, I think that is a really, really important point. And there is just a more natural approach to risking your own money versus other people's in how people behave. And a trustee, it's not your money.
Very interesting. Michael or David, on this cultural point, anything you wanted to add?
Yeah, cultural and systematic as well, Andy. I mean, if you're sitting on the trustee board, as I've done a few times, there'll be a stylized set of investments. Yeah. There will be an investment advisor that you feel, even when you're chairing, you feel you need to persuade before you're going to move anywhere. Anything that feels a little bit different is going to have lots of teeth sucking about. The last one I chaired, it took me 2 years to be told what the costs of fund management were for the endowment I was chairing, because that was not a normal question that people asked. So you get this built-in conservatism, and then when it moves like a juggernaut, so that you've ended up with the DB funds of Britain all invested in bonds, and then all of them taking on this liability-driven derivatives, which, you know, are gearing. And of course, rule number 1 from the 1950s is no gearing in your pension fund. So you get these moves, they take a very long time and they move like juggernauts. And yeah, it's way, way, way too conservative. And it would be a lot less conservative if we had much bigger funds, as Michael is suggesting, because you could have a few percentage that you could experiment with and so on. Yeah.
I'll just add briefly, I mean, I think the evidence is clear. It's entirely structural. If you look at for example, the number of startups in this country, it dwarfs any other country in Europe. If you look at the number of unicorns, valuable £1 billion companies, just that the capital to make them doesn't come from here. Right, there is the risk appetite, there's the spirit of adventure, there's the optimism, there's the entrepreneurial spirit, the innovation, the drive, it's all here. So this is an entirely man-made system that has stifled risk appetite, and to your point, and kind of frightened it out of people through these structural kind of scare. The speech you're given as a trustee, right? And so what are you going to do? But if you look at the culture, I've never bought this explanation that it's actually cultural.
I do think, though, we should not ignore the fact that there are examples of people who do break out, who do move in your endowment. I mean, some of the work we've talked about, our pension fund work, but at the Institute we're working with endowments and foundations as well, and moving beyond the idea that you've got your foundation to support the grants over here and a tiny little bit of impact capital over here. People are moving, they're curious about this, they know they've got to get the whole asset base working much more productively. So I do think there's curiosity, and I do think there's real appetite. And Michael, you made the point about the timing. I think we are at a point of timing where people are realising that just insuring away the future means you get the lowest common denominator, and it may not be the proper insurance. I don't mean that in insurance companies, I mean just insuring through your investment structures entirely.
And also, Elizabeth, if this is one of these things where you get the juggernaut and then suddenly you're doing it much better,
Yeah.
And we are at a point where there is a political consensus, both about all the CDC stuff that we've been doing at the RSA, but also about this is a matter of public concern, how 2/3 of our financial assets are invested. This might be a really interesting time to be starting to think about some of these debates, because
Agreed.
you could see over the next 10, 20 years, we could be in a much better place.
And just to lift the spirits on this cultural point, is I checked, and the Wellcome Trust and the PPF are both run largely by British people.
Yeah.
And they've taken risk, and they've earned very high returns over
Absolutely.
decades. So
I'm going to go to the room. I know there's lots of questions. I'm going to take 3 questions, and then the panelists will take 1 each. And your hand was up first, sir. So let's microphone. We now have a microphone.
Peter Wilson Smith. Can I just pose a question about this risk aversion idea? Because if you look at DB schemes in this country which are open and defined contribution schemes in this country, they actually have a higher allocation to equities than the global average. I mean, the issue
Exactly
is
right.
about the closed schemes.
Exactly right.
Which, you know, there's all sorts of complex regulatory and accounting reasons why they ended up there. But, I mean, they have invested quite rationally. If you're a mature closed scheme, you don't want to be putting a huge allocation into equities or unlisted assets. So what is the answer to that? I mean, what should happen to the 1.7, you know, in closed DB schemes?
Hold that thought.
Yeah.
Across here, gentleman here, and then we'll one at the front, and then we'll get to a second round, so third round.
Sorry, I'm maybe slightly confused here, but I think we started by talking about the pension system being broken. Should I read into that the returns of pension funds in UK is not covering the outlays that they're meant to do? And I'm just trying to understand, why is the pension system broken? Is it the pension is not generating enough returns to pay out what they're meant to pay out? Because ultimately, as a pension holder, all I care about is the value of the money that I get, but no matter where it's invested. And that, I mean, real value, not including inflation. So I'm trying to understand, is the panel saying there's a problem with the pension system because it's not producing returns that we expected, or is there something else we're talking about? Because I'm slightly confused, if you don't mind.
Terrific. And gentleman here at the front, final question, then I'll go back to the panel to pick off those.
Michael Moore, recovered politician, and I lead the British Private Equity and Venture Capital Association. So we've come at this from a slightly different take from some, but I would agree with the panelists that there's a lot of inertia, there's a lot of concern about risk, but trying to unite us all. I just wonder, is this a moment that will be sustained? Because I agree, the Mansion House speech was great. It raised lots of questions. It got lots of people committed to examining all the issues and trying to build some momentum. Was it enough? The fact that Rachel Reeves is talking about the same kind of things, is that enough? Where does the carrot end, and how soon does the stick come along?
3 fantastic questions. Let's go down the line and pick them up. Michael, you want to go first?
So I just address all 3 quickly? Is that okay?
Whichever one you want.
Yeah, well, no, just
David
probably the one that I'm
first.
best equipped, because it's a very good question, and it's different than the other, and the others are good questions too. Obviously the question of broken is subjective, but if, as I said to you, for example, last year, the DB pension system lost asset value of £400 billion because of concentrated overexposure to interest rate risk, and that the returns over the previous 20 years were less than 3%. And if you look at all the global averages, they're significantly higher than that. And that the Bank of England had to intervene. Your former Roost had to intervene at the request of the pension savers themselves, who begged the Bank of England to intervene to save the system because it was causing a systemic financial crisis. So you can judge based on just those 3 data points whether that's broken or not. But I think by any estimation that is broken, and the fragmentation of it, if you look at the small funds, 5,500 funds, and the level of gearing, the point that David made earlier, it's a system that wasn't working for anybody. And sure, the guarantee's there, but the guarantee's often for very small companies where it's not real anyway. So that's why we say it's broken. Yeah, you're right. You're right. Yeah, it was building slowly. It was building slowly, yeah.
The idea that a lot of private companies like this, they'll stop offering you.
Yeah, another, yeah. Well, I agree. You're right, you're right. You're right. The bond crisis seemed to be made visible, something that had been there for a long time. You're absolutely right. It's a good question.
So I think, I mean, just to that point, I think there's an intergenerational transfer of value and wealth that's happened in the 80s, 90s, where, and actually probably before, if you think about the protections that were put into DB schemes, the consequences of that, before we even had the change in accounting rules, which I think is a really important point as well, for a certain generation of people who happen to be represented on this panel, the DB scheme was really positive. It's very like owning assets at the beginning of quantitative easing. If you're an asset owner when you're going into that interest rate environment, you're privileged already. If you're trying to get on the scale of owning assets. So there's a generational mismatch here. And I think, therefore, your question is a really good question, but it's a hard one to answer because it depends which cohort you are, where you are, and where. But if you think about the people who should be on this panel, they're probably the people who are mainly represented in the front row here, who are significantly younger. And we're thinking about how is their future going to be financed. And it will need real inflation-proof real returns. How do you get that? You need that from a diversified, well-run, cost-effectively run mix of assets. And some of those opportunities you can only get to at scale. So for individual people not to be able to invest in infrastructure, in wind farms, in venture capital opportunities, within a risk budget, because I think the risk budget is key, it is shocking. But that has to be done in a way that is affordable and accountable, so it's not just hopeful. And people in future generations are sitting there saying, why the heck did they put that money in X? We knew that was never going to work. So it's not just a hope factor. So I do think there's an opportunity to grasp this now. And I do think there's a willingness to do it. I don't think it's about throwing out the responsibility towards individual members of schemes with the bathwater. I think it's about raising the standards and the opportunities for them to invest. And the thing we haven't talked about is time frame. If you have daily priced in your DC scheme, how on earth are you meant to take a 30 to 40 year view and a 50-year longevity view? If you have quarterly price and you have 3 years to prove an investment proposition, or 2 if you're unlucky, or 1 sometimes, if you don't think about that term to invest. But again, that's not laziness. It's got to be against some clear risk budget and return expectations and governance. So I think there's a real opportunity to change and raise the standard of what individuals get.
Did you want to pick up any of Peter's point maybe about open versus closed?
Yeah, and you're right. The open DB schemes are much more sort of sensible in the way that they're invested. I mean, the open ones, though, are mainly ones that are backed by the public sector because they feel that they can put that guarantee. But, I mean, if you were to go back and think about the BT pension scheme with Hermes, I mean, we invested in King's Cross, for example. British Telecom Savers did the biggest regeneration in the last 20 years. The problem is, of course, that the private sector doesn't want to give that DB promise any longer because of the cost on the balance sheet, but they could give a promise that was almost as good with CDC, which would give you the income for life, which is where I think we might go. The problem, though, is with the assets of the closed DB scheme, which, of course, if it's closed, then its longevity is less and less and less as every day goes by, and it's got no risk budget. But could I, Andy, have a go at the last question of,
yes,
this is an opportunity, can it be sustained? And it's a really, really good question. And if you're RSA fellows, by the way, you do need to write an email tomorrow morning to the head of the RSA and say you must continue to sponsor this debate. because look, I think on this CDC stuff that we've done, it has been, it does promise to be a really, really highly impactful change that we're bringing about. Lots of people through the RSA have done it. But you see the picture above me? That's what I looked like when I was started on this project. These changes, they do take time, and they absolutely demand a degree of consensus. And I think the question is, so we've got CDC that's coming in, and I think that's got a cross-party consensus. With just the 2 speeches from Labour and Tory that are saying, this is a big question we ought to be asking. I think we ought to be asking it because I think we can give better returns to people, both financial returns and social returns as well, if we open up that debate. But I think it does require all of us to be together saying, look, let's look at both sides of the pensions balance sheet. We've opened up some interesting stuff on CDC, I think. But let's think about all of that, and then let's think about how is it that this can be invested so that it's giving a good return in the interests of the British people who have got 2/3 of their financial assets invested. And as I say, no one's ever asked that question before. No one. Amazing.
I'm going to take 2 more questions in the room. And to Amy as well. So.
Jesse Griffiths from Finance Innovation Lab. Brilliant panel, really interesting conversation, thank you. 2 big issues that haven't really been touched on that I'd like to throw in there. One is, what do we do about people on low incomes? So current pension assets, bottom 40% of the population have close to 0% of those. What would you do in your schemes to make sure that they get reasonable retirement income and don't have to just rely on a state pension? Second, climate. We've got to move assets so much quicker out of fossil fuels, in particular, stop investing in new expansion. Isn't that going to take more interventionist policy from the government towards pension funds, or are we just going to rely on the trustees to do that?
Great questions. Let's go to Amy for the final one, and then I'll go to the panel for their wrap-up comments.
Yes. Good segue from the previous question, but Elizabeth, you spoke about pensions kind of doing more social good, and you also spoke about the just transition, and I guess the just transition and kind of the transition to a more just future beyond climate obviously has a broad socioeconomic dimension, but it also has a spatial one, as we need not lecture the chair of the Levelling Up Task Force, of course. So how do we direct more pension investment to the regions of the UK, even if kind of investment incentives might not point that way automatically? And as Andy and David know, I have only a slight vested interest in the answer to that question.
I'll pick up
We're taking notes at this point. Let's go down the line on those 2 sets of really fantastic questions. Michael.
The climate of the 2 is the easier one to address, because if you look at the returns, I mean, obviously there's a spectrum of returns across different technologies, renewables, for example, and solar and wind all have different profiles and characteristics. But in terms of the market will supply capital, the irony is in this country something like 80% of all the wind capacity and solar capacity is funded by equity from outside this country, because there simply isn't the reservoir of capital to do it. So I think that one's easier in the sense that because the returns are there to do it, if the structures and the incentives are allowed to allow it. The point, it's not come up before actually, it's a really good point, is how you deal with the 40% who are underserved or relatively low incomes. And I won't pretend I come here today with a fully baked answer to that, but I think it has to be in some ways tied back to this whole concept that there's not going to be new DB funds created with a pension promise for these people, but to the extent the employer contribution is far too low, for example, if it's like it's 8%, and it's simply insufficient. Particularly, you could imagine, for example, I'm throwing this out as an idea, that the lower somebody's income, the higher the percentage contribution should be in order to ensure some minimum contribution of the corporate sponsor. And the problem is a lot of people at the lower end of the income scale are probably in more transitional employment, and therefore it's harder to actually sustain these contribution levels. So I want to reflect on that, because it's a really, really good question. I think while we're fixing the whole thing, we have to address that. You can't just leave 40% of the population out. So I'll leave it there, but those are 2 great questions.
Thank you. Michael. Elizabeth.
So I'll come back on the whole question of what we at the Institute call place-based impact investing. We do that work as well domestically here. We've been doing it actually supported by the DCMS and the City of London Corporation. We work in communities. So Wakefield is the one we're currently working on. We're looking at 2 other opportunities. It's about changing the mindset of local opportunity investing from the deficits in a local community to the assets they've got to invest in. And if you think about a lot of how municipalities and local communities, particularly in deprived areas, it's a sort of cap in hand to central government because we've got a deficit, we need more. Actually, many places have assets that are underutilised, underinvested in. So it's all about changing the dialogue to enable local people in local places, small, medium and large, to identify the assets, to identify the investment opportunities. And they can be artistic, they can be sporting, they can be natural resources, they can be anything. And then forming a coalition of people willing to spend time having that conversation. Because you have to find a common language between city folks like me, somebody in Wakefield who really understands what their community needs, the investment opportunity and the time frame. And that's what we've been working on as a separate piece of work. And I think it's got an amazing opportunity for a significant proportion of areas. There will be areas of the economy that are so destitute that unfortunately the opportunity to reinvigorate and reinvest, and you know this better than I do, was 20, 30 years ago, but that does not mean we shouldn't stop focusing on inward investment into fantastic places we have in our country through place-based impact investing. And that's something we are working on. And again, the whole point is not just to be a talking shop. You've got to have a toolkit. Then you've got to create these coalitions. You do need some sort of anchor, whether it's a local council, whether it's a local employer, whether it's an education. You know this better than me, all the work you're doing. You need an anchor that you can build on. But it's amazing what can happen when you basically give people the power to do rather than just to be deficit funding. And I think it's a very exciting area that we should absolutely incentivise.
Fantastic. David, bring us home. Could you pick up the low-income point, do you think? The low-income point.
Yeah. Look, we haven't, Jesse, we haven't addressed in this what you do about low income or about self-employed, of course, because we're not clear how it is that we deal with the self-employed. The low income in particular, it seems to me, like many financial services, we treat all financial services like you just leave it to an open market, you know, like haircuts or clothing or something like that. The fact of the matter is that there are certain things in the financial services industry that are utilities and that we need to think about providing like they are utilities, like a bank account. I mean, it's why I'm no big fan of Nigel Farage, but he needs to have a bank account. So does everybody. Everybody needs a pension. Everybody needs a basic insurance. And I wonder whether it's a bit beyond what we're talking about here just on pensions, whether there's another debate to be had, whether there aren't some critical parts of the financial services industry that are utilities, and we should think about them that way, and our banks and our financial institutions should be making sure that everyone has got access to them.
There's another initiative, you know, the dormant assets in banks have been used for various things to stimulate, and that was a great invention again, invented in the UK, to stimulate the use of those dormant assets in social enterprises, in community redevelopment. Some of those are also being used in Fair for All Finance, Sasha Romanovich and others, and they are one of the biggest issues in low income is living on credit at the wrong price. If you don't eliminate living on credit and payday, you will never get to the point where if you're in transitory employment, very difficult to get the actual payment into a pension scheme. So they're doing some fantastic work on bringing fairness into finance for the lowest paid and the most deprived. I think there's a lot more we could do to innovate in those areas as well.
Listen, the witching hour is upon us. We should draw things to a close. Let me just wrap up by thanking everyone in the room for coming along. Indeed, the huge numbers I know watching online as well, and for all the questions both in the room and online that got sent in, dozens and dozens of them, and superb quality, I have to say. I'm sorry we didn't get through more of them, but we got through a lot in the time. If you're an RSA fellow, I want to keep having the conversation. You can do that using our digital platform, Circle. You'll also find on there a load more information about David's CDC forum and about all the other stuff that the RSA is up to. If you aren't an RSA fellow, what are you thinking of, really? You know, now's the time to sign up, and speak to me afterwards if that at all sounds attractive. Speak to me afterwards anyway, actually. And finally, last but by no means least, of course, please join me in extending a huge thank you to our amazing speakers this evening, to Michael, to Elizabeth, and to David. Thank you from all of us.